Okay, if you've watched my channel before, you know that I like this movie. It's called The Big Short. What we got going on now is The Big Short 2.0, kind of like my channel. What's it called? Housing Bubble 2.0. So we're going to talk about what's going on behind the scenes right now. So welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, their episode of As the Housing Market Turns. Today is what? It's the 21st of May. Hope you're doing well. Friday, it's time to clear the desk on Friday. I know this is kind of an interesting video topic for today. FYI, yeah, I know that NAR put out their existing home sales report, and quite frankly, do you want to talk about how expensive things are and how low inventory we have? I don't either. So that's why I'll do that in a subsequent video, but we're talking about The Big Short right now. First of all, though, this video is brought to you by our friends at Foreclosure.com. So if you want information and want to find out the distressed properties in your area, your neck of the woods, go to gethousingdata.com. Foreclosure.com is the nation's leader in distressed housing listings. So go to gethousingdata.com, subscribe, and you can find out what's going on in your area to find the best deals right there. This information is important for the future of real estate and if you want to buy a house. Now, we're going to talk about this very interesting article came out today. So former subprime player claims he can now short the mortgage market for climate and COVID risks, which I think is kind of interesting. So I want to be clear here, though. When we're talking climate risks, he's not talking about, global warming and, the Antarctica and penguins and stuff like that. He's basically talking about things like floods, fires, hurricanes, storms, like, winter storms, tornadoes, whatever, because, more of that's actually happening now. And some specific areas of the country are, you typically get hit worse than others. So it becomes an issue. And basically people lose their homes or have major issues afterwards. So this guy's name is Dave Burt. He's a financial analyst. And basically he was doing sort of this back in 2005. And he was kind of involved in that Big Short stuff back in 2005. So, he was right there. So he certainly is educated and knows what he's talking about. He's looking at, how mortgage loans are basically going to fall apart, by zip code, by location, by region for different house price scenarios. So pretty important here. So the whole point he's making is that risks of flood, fires, and wind, the cost of owning a home goes up from cost of higher insurance rates, higher taxes, and uninsured losses. And as the cost and home value goes up, the value of the home goes down, and consequently, the mortgage on the home is at a higher risk for default. So I think it's kind of interesting how he's sort of positioning this, which is interesting. So of course, this is all about mortgage bonds and how you're shorting mortgage bonds, etc. And basically, he thinks that in the nutshell, he thinks those bonds are overvalued because by his calculations, close to a third of U.S. homeowners are vulnerable to big losses in the value of their homes for climate change. So this is kind of his focus here. So over the past few years, probably the past 5 or 6 years, we've seen an increase in hurricanes, we've seen an increase in flooding, we've seen an increase in tornadoes, an increase in massive snowstorms in the Northeast. We've seen an increase in wildfires in the West Coast, especially California. For example, people pointed out to me, that Paradise, California, I wondered why that had such a situation. Well, it was ground zero for one of the big fires out there. So, this is what's going on in our world, in nature. And, people take notice of this. And I can tell that people who were back in the day figuring out, collateralized debt obligations and credit swaps, all the cool stuff they did to make billions of dollars, hedging their bets against the housing market, they're doing it again today because they know how and they can and they see the signs. So the point I want to make here is that clearly people see what's happening in the marketplace and they're going to jump on this. Well, they're not going to. They already have, and that's their plan. So please keep that in mind. One of the things that I think is very important is when he starts looking at this is that he's looking at climate. He's also kind of thinking the fact that that COVID's going to basically add to that too. He's adding the coronavirus to the mix because he believes climate and COVID together make the bet even bigger when he's shorting it. So basically, that's the situation. He's looking at distress, and he's looking at future distress and how things can play out, which is what these people actually really need to do. What's really interesting, though, is that when they're talking about how stuff plays out, COVID has created a lot of problems. Fundamentally for the systems that support the housing market, and have been potentially contributing in the mispricing of these climate risks and asset values. Namely, the insurance premiums are too low, he's saying. Now, about 3 million mortgages are now in government or private sector COVID bailout programs, i.e. forbearance, etc. And there's no guarantee that those borrowers will ever get current on their loans, so the homes are at risk of foreclosure. So that's a very powerful statement, and why I want him to highlight that, because he's exactly right. If these people are still in these programs, and it's been over a year now, and they're still able to stay in the programs because of the extensions that FHA and the government, whoever's offering, then that clearly indicates that they can't get out of COVID. All right. So regardless of we'll call it the housing, the housing boom, people who are saying, they're just going to sell their homes, all this equity, blah, blah, blah. That's not actually happening, because I look at it going, if you could get out and solve your problems, you should have done so already should have done so. And I'm trying to say, like, why would you wait? Cash out now before things, fall down. So if you can't cash out, then clearly you have other issues going on. That's very unfortunate, but that's part of the nature of this business, right? So in other words, the people that can't go are going to stay, and they're going to stay to the nth degree as long as they can, and then things are going to be crashing, so that opportunity's been missed, okay? Second point that he's making here is that you're talking about very high delinquency rates of mortgages that we all thought were much higher quality than, for instance, you saw before the crisis. So this is a second telling statement here, because part of the, I guess you could say, again, the pro-housing boom people, I call them the housing hype hacks, right? Because we're the foreclosure and forbearance bubble boys, whatever. But the whole point, though, is that part of their reasoning and to substantiate the fact that we're not going to have a housing crash or crisis or issue is the fact that mortgages are great and lending standards are tighter, and this is great. Well, this person who can probably see things, quite readily with their analysis investigation. And again, another reason why you need to watch The Big Short, because it talks about how loans are put into various loan tranches and how they're actually packaged and how they are sold or not sold or repackaged on the secondary market. Okay, so that's why, if you haven't watched the video, watch it. If you don't have it, go to YouTube, and there's tons of like 8 or 5 minute bits from the movie. You're going to pick up enough. I love the movie. Why? Because it's a good movie. It's fun, good actors. There's some humor in it. And during the movie, they have all these little outtakes where they actually explain what these definitions are on the fly, so you can understand in very good and easy terms what's going on and what happened back in the day. So got to recommend it, okay? Every so often when I'm feeling down, I put this movie in and I go, you know what? It's going to happen again, all right? So it's kind of like my feel-good movie, which is sad, right? Anyway, the whole point, though, is that he's talking big delinquencies coming. Rising foreclosures cause surrounding home values to fall. Home prices right now are inflating fast because of the huge demand from COVID stay-at-home culture. So that's the whole thing. So, yeah, it's an artificial situation right now. So when you don't have the stress coming in the market, when you don't have additional inventory, you have low interest rates and this other sort of artificial situation pushing everything forward, it's really designed to crash. That's the way it goes. The bubble keeps going until it basically bursts. So ultimately, in the end, I think it's very important that what he's saying here is, he's saying 3 million mortgages or so right now, and that's, I think, again, that's conservative. And we'll talk about values in a second here. But the whole point is that the high delinquency rates, and the fact of the matter is that not every loan out there is an 800 credit score, 20% down, fully documented loan with a 6-figure income riding behind it. That is the point. So as this plays out, things are going to change, and people like this who play with billions of dollars behind the scenes are betting the same thing that happened last time. They're betting on it again. Mark my words. All right, let's take a look at something else which I thought is interesting here. But hang on a sec here. But first of all, if you're not already a subscriber and you appreciate the information that I have on my channel, please do me the honor and smash that subscribe button. And second, if you think you're a subscriber, could you please double check and hit it again anyway? The reason being because I've lost lots of subscribers over the past 6 months for various reasons. And that's what happens sometimes on these meetings. So please resubscribe just to make sure that you're in the system, all right? So this came out today too, and we're talking about the commercial side. So we just spoke about the residential issues and the Big Short 2 points on the residential side, but we got it happening again. This is what they actually call the bigger short, is the fact that this time The issue is not a bubble in the housing market, but apparent widespread inflation of the value of commercial businesses on which the loans are based. All right, so this is an interesting article, and I'll put the link in the information section of the video. I won't get into too much, but the whole point is that we've got, it's happening again, not necessarily on the residential mortgage-backed securities, but on the commercial mortgage-backed securities, the CMBS. All right. Basically, we found that the industry-wide scheme is colliding with the collapse of commercial real estate market amid the pandemic, which has business tenants across the country unable to make their payments. So yeah, certain segments of the commercial mortgage-backed security marketplace are taking a beating. And the point they're trying to make is that back when they originated some of these loans, even back to 2013, what they were doing is they're in their underwriting, I guess. The operating income falls short of underwritten income by 5% or more in 28% of the loans. This is across the average, across the board here. And certain groups have, Bank UBS, the Swiss Bank UBS, Goldman Sachs, Citigroup, Morgan Stanley were significantly worse, having more than 35% of their loans exhibiting 5% or greater income overstatement. So basically what they're saying is that when the numbers came in, they were being overstated for whatever reason. So it's kind of like, hey, here's our current rent and here's our future predicted rent or whatever. So there's probably some overstating going on there. I'm not too sure how the math and how it all works out. But the point is, look where we are today. So if loans were based on net operating income on a forward-looking basis, well, look what's happened now. You've got certain segments that are going to get blown out of the water. This is just a chart that shows all the bottom axis shows the different providers like Morgan Stanley, JP Morgan Chase, UBS, Starwood, whatever, and then those little marks in the graph show how much it was overstated, up from over 10% to almost 50% here. So that's really, I don't know how that gets through, but that got through, and of course the loans look good and they get packaged and out they go. The point to all this, though, is that essentially, this guy whoever is involved in this article or they're writing about, he's a whistleblower. He filed a complaint with the SEC that states that he's identified about $150 billion in inflated commercial mortgage-backed securities issued since 2013 with banks such as Wells Fargo, Deutsche Bank, and other shadow banks that are around there. So there's a lot of shenanigans going on behind the scenes. It's going to cause some problems. And the unique thing about this is that we are going to have residential loan mortgage problems coming the next couple of months. And at the same time, we're seeing how the commercial side is going to play out as well, too. So it's like we got a double whammy coming on here. And, how does it work? Well, take a look at this graph shows the delinquency rate based on segment. So you have office, industrial, retail, lodging, multifamily, so to speak. So ultimately in the end, people thought multifamily would take a beating. It actually hasn't. It's had delinquencies as well, but it's not as bad as everyone thought. Things like industrial has been okay, but the two main issues are the the retail side of things and the lodging. So lodging being hotel, motel, retail side being shopping malls, shopping plaza, strip malls, whatever. Office has actually fared reasonably well, but everyone's predicting that we're going to see a lot more office delinquencies, segments coming up as well too, just because of the people working from home and whatever, which is interesting. And also there's locations. I didn't even talk about this today, but there's places, for example, in the San Fran Silicon Valley area where all these big companies actually ended up they grabbed all the office space they could, and now it's like an office space glut, you see, because they don't need them anymore. And they got them because they needed them for the future. And now with the pandemic and how people are working away and working from home and relocating stuff, they don't need it as much right now. So there's a huge office space glut. And I know that banks are, or not banks, but some of these large companies are taking write-downs on, we'll call it their rent issues and stuff like that. So again, the whole point being that the commercial side is having some major effects, and it will play out as well too. So we have a residential situation coming up, and we've got a commercial that we're just working through right now. That's only going to get worse as time goes on. It's going to be regional, it's going to be et cetera. But the whole point is we got stuff happening here, kind of like the last what's called the Great Recession, right? We had the housing bubble plus other economic factors, stock market crash, whatever, that created the Great Recession. It wasn't just a housing bubble; it was a number of things that kind of added up. Are we going to have the same thing happen again here too? We've got residential that's going to start crapping out. We've got commercial who's starting to play. Everyone's talking about pending stock market crash. So who knows? But the whole point is now we have multiple segments of economy they're starting to show a lot of weakness and a lot of issues. So that's what we have, I guess, to look forward to. So I'm going to say it's time. And when I say it's time, it's like, what do I mean by it's time? Well, it's time to start thinking about this. It's time to start getting involved with this. It's time to start learning this because the market's at its breaking point. Okay, as I mentioned, do we care how double-digit appreciation in with NAR? I don't care anymore. Do we care the inventory that's not there anymore in prices and bidding wars? We don't. Why? Because we don't want to purchase property at the peak under stress and speculate and things like that. So I think the market's at its breaking point. And what's going to happen is once the summer selling season ends towards August and we start seeing these forbearance programs stop and things fall out of that, suddenly the market's going to look a little different, or there's going to be more opportunities, or things will change here. Okay, owners and investors will need to liquidate starting now. Foreclosure auctions are back on track, so we're starting to see more homes get scheduled for foreclosure auctions. And I can tell you, it's not just the vacant homes. They're out there, they're homes with people in them. Why? Because I drive by them and I see them. Okay, foreclosure filings or starts, they're increasing. One of my last videos, I talked about 24 states have year-over-year foreclosure start increasing. Certain states, certain lenders say they're going to do that. Certain court systems saying we're going to push stuff through now too. Going to lead to more short sale opportunities. This is where to look for the deals. More will be available than predicted. We're not seeing the true numbers. Now, the real issue is, what is the true numbers? I mean, come on, right? That's the whole thing. Everyone asks me the question, how much of this will actually hit the marketplace? What are we looking at here? Is it like the last housing crisis? I can tell you that, as I said, the pro-housing people, the talking heads, they're so desperate to make sure the narrative is going that way, and they're so clear saying, here's the reasons why we're not going to have a housing bubble burst or crash or whatever. Like it's almost a point where every other article is about that. Every other person is commenting about the reasons why we won't. Better lending standards, owner occupants, no speculation, blah, blah, blah. Well, you know what? We're starting to see that argument kind of get debunked pretty quickly now. And we're seeing very smart people behind the scenes not even caring about that. They see what's going to happen from a number-wise situation. And as I mentioned before, true analysts, guys with the numbers, guys and girls with numbers, they can see the cracks of the market a year or two before it actually happens. So people are preparing for this, all right? Just you got to, that's why as much as people go, you've been talking about this for a couple of years, yeah, but you know what? Yeah, it's artificially controlled and it's being stretched out as long as it possibly can for various reasons. It's going to hurt us down in the end. Okay, so Black Knight focuses on forbearance. That's pretty much their only thing right now. Talking about the forbearance chatter, 2 point whatever million. I think I looked earlier today, was 2.16 million with a small uptick, of 16,000 or something like that this week in forbearance numbers. And that's the whole thing. Realize the forbearance numbers is an extrapolation of samples taken from a certain percentage of banks, lenders, and servicing companies. Okay, so it's a made-up number. It's not a accurate number. As a matter of fact, as I keep saying, I think the number is much higher because of the way they calculate it. And I know that the provider of this number, not knocking them, but what I've noticed over the years and other statistics, they've been very conservative. Adam Data Solution, after watching a few webinars and they've adjusted here and there, we're talking about 3+ million foreclosed homes, from 2021 to 2025. That's what they're talking about. All right. So again, the White House back in February, when the White House put out the statement, the press release talking about we're going to extend the eviction moratorium and forbearance, they mentioned that there are 10 million adults not paying their mortgage. So of course, I think I did talk about this. After a little more investigation, it's not 10 million adults not paying their mortgage. It's 10 million adults living in households not paying their mortgage. So if we just take some basic rudimentary math here, two adults per household, that's about 5 million people not paying their mortgage, which is certainly greater than 2.1 or 2.2 million. Okay. Now I look at it going, now we know that 2 is a nice nuclear family number, and we don't really have that anymore. So maybe it's 1.5 adults per household. Maybe it's 1.2, 1.75. Who knows? So I'm thinking we got 5 to 6.5 million situations here with potential foreclosures coming in the next little while. All right. So my number is 5 million plus. All right. It's a difficult number, and we're just rolling the dice here, right? And I heard yesterday, I was on another webinar listening to somebody, and they're predicting. They say there's going to be 10 million situations going on with defaulted mortgages in the next couple of years. We're going to see 10 million. So you can see that from 2 million to 10 million. There's such a vast vast, I guess, divergence or difference in the numbers, it's going to be somewhere in the middle. That probably 5 to 6, somewhere in there, I think is safe if you want to take a conservative estimate. All right, but what it boils down to is the fact that it's a difficult number. For example, this just came out today too. Mortgage delinquencies should return to pre-COVID levels by year end. Okay, so this, again, we're referencing some Black Knight stuff saying, hey, we're not going to have any problems here. Okay, but if you actually take a look at the last part of the article, the last paragraph says, and I'm going to read this out loud here. As of right now, it looks as though the end of the third quarter and or the beginning of the fourth quarter will be an inflection point in terms of our understanding of how the post-forbearance world will shake out, said a Black Knight rep. Until then, all improvement is welcome news. So yeah, when we see people jumping out of, not jumping, just their programs are ending, so therefore it's a pay count win on the forbearance chart, all right, on a weekly basis. Yeah, we'll take the wins and the improvements right now. But they've just said it here, folks. We don't know, okay? It's an inflection point, and it'll be how we understand how this will play out. So what it boils down to is that very clearly, all right, what's about this is the fact that no one really knows what is going to happen, all right? That's the whole point. So we can all speculate, which is what we're doing here, 2 million to 10 million, somewhere in between. The people who are providing the numbers are actually saying, yeah, because in the end they're just number crunching with some calculation. And again, I'm not knocking, I'm just saying we don't really know. Okay, so as it says here, never give up. No one knows what's going to happen next. That's why I firmly believe when you start peeling back the layers and you start hearing people talk about, well, we're not only just looking at foreclosure stuff, we're looking at CDOs and shorting these mortgage-backed securities and the whole bit. So basically, they made billions of dollars back in the last housing crisis on a bet, and it turned out correct. The people who did it, the people who are in the financial world, everyone's going to be working that same angle because they see exactly what's going on right now. They have the inside information that we don't get. Again, I'm sure on Wall Street, if you're a Wall Street player, you can call up some lender and say, somebody in there and go, give me how many mortgages are delinquent. We see Black Knight saying 2.1 million. Well, they're going to come back and say, well, no, we have this, and then you start pooling all those numbers. I'm sure the guys and girls who are doing this have way better intel than we do, and they're not getting the retail stuff fed to us. They've got the inside scoop and know what's going on. That's why they're doing this. All right. Why else would they do that? All right. So the point is, expect worse than I think is being talked about. Would it be nice if everything sort of worked out great for everybody? I'm sure it would, but that's not the way things are going, guys. Simple as that. And I'm not trying to be negative, but I'm just going, this has happened before, it's happening again. We got to go with the facts, right? So how do you take advantage of all this? Well, guess what? I've got 2 programs, okay? I help buyers buy and sell. I consult. I help people get properties for investment. But if you want to know how to participate in this next market change, I've got 2 programs. Short Sale Cash Connection is my advanced short sale deal. Tell you everything, show you exactly how to do it, work with you the whole bit, very in-depth. You'll know what's going on. I just spent a few days, past couple weeks doing powwow sessions with our attorney, and we've figured out some new angles. We're going to hit this, and we're starting our marketing on that very shortly, which is good. So, ping me on that. If that's too intense for you, but you want information on what to look for, etc., how to participate in the distressed housing market, how to save money on your retail purchases. Zombie Foreclosure Flip is more of a entry level, but my entry level is more intense than the entry level you'll see out there anyway. But the whole point is, it's going to show you what's going on and where to look and how to get and how to ask for discounts and get some stuff in your pocket as opposed to somebody else's. So that's the whole thing. So why do I say you should do this now? Because this is an example of my MSA, the Tampa St. Petersburg Clearwater MSA down here in Florida. All right, look at the median sales price there, $295,000. Look at the short sale median sales price. All right, $217,000. This is back in February. This is the most recent data for the MSA like this. Single family homes. Look at their $77K in equity difference, 26% discount. Our system with the attorney and everything and how we do it, we know we can get better discounts. We know we can get more equities. That's the reason why you want to do this business, whether it's investment or learning how to find your primary residence and not paying record prices. You want to start learning stuff like this, okay? Because there's always a method, there's always an angle, there's always a way. Going to Zillow and talking to your real estate agent primarily, it's not going to work for you. Okay, you got to take things into your own hands, learn some stuff on the fly, become educated, so you're a better equipped buyer for the future. All right, guys. So how do you reach me? Send me an email with all your contact information. I'll certainly get involved with you, and we can chat and see if there's a fit there. So thank you once again for the views, likes, comments. Please subscribe if you're not a subscriber. Once again, reach out to me if you want to talk some more, and I look forward to speaking with you early next week. Happy Friday, guys.